Hello again and welcome. For those of you who may be new to Source Advisors, we've been helping CPA firms. We've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Arlington, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features, which are located in the upper right corner of your screen. If you have a question specifically for our presenter, be sure and use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. And lastly, a PDF of today's presentation is available for download now. Should you wish to follow along or reference it afterwards, you can find that under handouts in the upper right corner. With that, I'd like to introduce today's presenter, who is Kamal Shah, Managing Director of Indirect Tax at Source Advisors. Kamal has been in the tax industry since 2005 and has assisted many companies, ranging from startups to Fortune 500 companies, with complex tax matters. Over the past 15 years, Kamal has successfully identified and recovered more than $75 million in overpaid indirect taxes for his clients. And with that, I will hand it to Kamal.
Hi, thanks, Ann. Hi, everyone. I'm going to try to stay on camera, but if we're having connectivity issues, I'll jump off. So as Ann mentioned, my name is Kamal. I'm the Managing Director of the state and local practice at Source Advisors. I am a CPA by trade, and I've been in this space for roughly the last 20 years or so. I'm excited to do this presentation. I do a lot of these CPEs. This is my first time doing this specific one. We felt it was warranted based on all the new things that are going on in the market with technology and with services. A couple of things I want to mention before I go into the presentation is, if you're perusing through the presentation right now, you will see that although some of it is dated, I just made the presentation within the last 30 days, but there was a lot of court rulings that happened in the last 30 to 45 days, specifically one in Maryland that came out on August 14th that basically repealed the law that I'm going to talk about in a little bit. But in addition to that, that's the first thing I want to mention, that some of it has changed within the last 30 days. And the second thing I want to mention is the reason we're doing this, talking about both the taxation of electronically delivered goods or software, digital goods, and services and data centers at the same time, is because there's a lot of businesses out there that are trying to walk that fine line between being in the tech space or leveraging tech to provide services. And the way the states are kind of getting around that is they're just taxing everything, or they're taxing both sides of it, and they're expanding their tax base. So we're going to touch upon that, but let's go into the presentation. This is the agenda. We're going to identify how states are currently taxing software, SaaS, and digital goods. Kind of explain how the current market is for sales and use tax. Why is it the way it was, and why it has been the way it has been for the last 10, 15, 20 years. Why is it changing? Recognize that states are now adding service categories to their taxability base in between 2024 and 2026, and we expand to see that increase. Why is that, and how is that going to change the sales and use tax landscape moving forward? Third, we're going to describe the mechanics of the state and local tax exemptions for data centers and investments. Data center exemptions, I think something like 38 states, 38 of the 45 states that have sales and use tax are offering incentives around data centers. What are the restrictions behind that? And like I mentioned with some of the other things, states are already starting to pull back some of their data center exemptions. They want that business, but what they're seeing is the increase in employment and some of the other metrics that they were looking for isn't there. And then the final thing we're going to touch upon throughout the presentation is, how can you as tax professionals advise your clients in the face of all these changes that are going on? Should it be through a nexus study, having to do nexus studies where you perhaps weren't before, doing a taxability matrix, which is reviewing the different things your client is selling for taxability purposes in different states, and then how to become compliant through the use of voluntary disclosure agreements. Okay, so why is the tax base being redrawn? The tax base that's currently in place for sales and use tax, it's actually been in place since the 1930s. Fun trivia point is that Kentucky and Mississippi were the first states to introduce sales and use tax, and they introduced it in 1930. The consumer and business spend has significantly shifted, right? The easy example to think of is like TVs. 10, 15 years ago, TVs were thousands of dollars, inflation adjusted. Now you can go buy a 60-inch TV for a few $100s. More and more of our service, more and more of the money we spend as individuals, as taxpayers, is on services and digital goods. So the states, their revenue base is decreasing, and at the same time, their need for revenue with pensions and the cost of everything else going up, they need to grow their base while the economy or the types of goods that they traditionally targeted is shrinking. There's parallel legislative strategies to redefine how software digital products are. One of the common themes that we're going to talk about is that how some of the states got around the taxability rules is rather than saying, hey, software is now taxable, some of them, just like California, said, you know what? Why don't we just say that the definition of tangible personal property, which is how the law was written, now includes software? That's just a much easier fix than trying to have the entire law change. So at the same time that they're doing this, that they're trying to tax these new things, they want to put exemptions in place for big businesses to attract their data center growth in their specific states. You guys have seen Mississippi, Alabama, New York, Illinois. A lot of states have different exemptions in place for businesses to come in and put in major capital investment. And then they're also, but at the same time, they're also doing, for population growth, they're taxing grocery items and personal care items. So there's a big disconnect in what the states are doing in the different parts of the tax law. They want to encourage revenue growth through taxing digital goods and things like that, but then they want businesses to come in and they're giving exemptions for the businesses. So this is why right here. In the 1970s, 55% of our economy was based on goods and services being sold that were subject to being taxed. Now it's only down to about 35%. The sales and use tax, the tax foundation did an analysis and said, of the $17.5 trillion that was spent in the economy in 2022, 10.5% is feasibly taxable. What does that mean? That means that if you exclude housing, insurance, healthcare, education, and some small categories of goods that are federally banned from being taxed, that's about $10 trillion in spend. So there's a lot of different areas that states can touch, and they're finally starting to do that. And what really started this is the Wayfair decision. The Wayfair decision, what it did is by allowing remote businesses to be held responsible to collect taxes in states where they don't have presence, as long as they're delivering goods. And that's a very general statement, right? You can deliver goods via FedEx or USPS, but you can also deliver goods electronically. So that really opened the door for states to expand the amount of businesses and the amount of services that they can collect tax on. State sales taxes were built around an economy that sold mostly goods. Consumer spending has since shifted. So we mentioned the revenue pressure, right? The digital remote work economy. Now with people working from home, being out of their house a lot, not being out of their house as much, getting everything delivered into the house, they needed to figure out a way to be able to target goods and services that people are receiving at home. They're doing this in a bunch of different ways. The bottom point there is that Vertex counted and saw that in 2025, 335 new local jurisdictional taxes were created. The average sales tax rate went to 5.6%. That's just the state rate. And most jurisdictions now have the state rate, and then on top of the state rate, they have a county rate and then a city rate. So the amount of tax, the tax rate across the country is increasing for sales and use tax, as well as the goods and services that are being subject to sales and use tax. Okay, this is the first of 4 polling questions.
All right. What U.S. Supreme Court decision established economic nexus and enabled states to require remote and multi-state sellers, including many service sellers, to register and collect sales tax? A is Quill Corp v. North Dakota. B is South Dakota via Wayfair. C is National Bellis Hess versus Illinois. And D is Complete Auto Transit versus Brady. This is our first of 4 questions. You do need to respond to 3 of 4 and attend for 50 minutes to be eligible for CPE. If you are having trouble seeing the button that corresponds with the answer, please make certain your brightness is all the way up. And with that, it looks like the majority say B, South Dakota v. Wayfair.
Yep, that's the right answer. So that was the Wayfair decision. I think most tax practitioners are well aware of it. It's worth mentioning that the Wayfair decision actually superseded the last Supreme Court decision that said physical nexus was what you needed, and that's A. Quill in the North Dakota decision from 1992 was the decision that Wayfair superseded. Okay, so California was the big one. California is the largest state in the largest economy within the United States, and it was probably the last big state that was still exempting software. I think with California now taxing it, New York taxes it, Illinois, Texas, the next big state I would say is probably New Jersey is probably the only big state at this point that does not tax it. That does not tax software. But starting of January 1st, California is reversing 20 years of policy. And as I briefly mentioned before, the way they did it administratively is they basically redefined the definition of tangible personal property. They said pre-written software now, regardless of the delivery method, which means whether you buy it electronically, which most software is, but even if you get it through a physical medium or any other medium, SaaS, anything like that is going to now be subject to tax. And when they tax it in this way, they make it very expansive because you have companies that are trying to say, you know what, we're not going to sell it based on license count. We're going to sell it based on usage, or we're going to sell it based on the amount of revenue that it processes or some other metrics. But these definitions are expansive on purpose. So it includes all the different variations that a client might try to do. What is going to remain exempt after this rule is custom software. Again, the threshold, a lot of people think that their software is customized because it's meant to meet the needs of their business. That's not what this means. When most states that tax software still exempt custom software, when they say the customizing the software, it has to be the source code that was changed for that client. Right? It can't be just integrated or customized to be able to fit their ERP or their point of sale system. It has to be a change of the coding at the source code level. Also remaining exempt are digital assets, cryptocurrencies, things like that, and then cloud infrastructure, which is IaaS is infrastructure as a service, and PaaS right there is platform as a service. So those things are for the time being going to remain exempt. The last point at the bottom there, the $5 million gross receipts threshold. That's a very obscure rule. I'm not really sure what the purpose of this rule was, but it basically says that if one company is selling more than $5 million of goods to another company, then that seller is not responsible for charging tax. I imagine this is for really large companies tend to have something called a direct pay permit, where they're telling the state that, we buy a lot of things from a lot of different companies, so we're going to have our own process to pay tax on everything, and we're not going to have anybody charge us tax. So again, very small, obscure rule that's only for the benefit of really large companies. But key point here is California is going to tax it starting 2027, and it doesn't look like there's any sort of court rulings or anything like that could stop that from happening, which was different than what happened in Colorado. Colorado was one of another large big state that started taxing software. Colorado had a few things going on. So I'm going to kind of jump around here on this slide. The thing at the bottom is talking about Netflix had a decision that was under appeals in Colorado. The Supreme Court had heard the arguments, and the decision that they were going to make is that should streaming services, should that be included in the definition of tangible personal property? Because as I mentioned, and as the slide says over there, Colorado, like California, made the administrative changes, the legislative changes to change what TPP was. Unfortunately, before the Supreme Court of Colorado came out with that decision, Netflix and the state of Colorado came to a decision on what exactly, they came to terms of agreement on their case. So the Supreme Court didn't have to make a decision on whether or not streaming data qualifies as tangible personal property. So that's still outstanding in there. But moving forward in Colorado, software is going to be subject to tax. Like with California, the only thing that's going to remain exempt is either is going to be pretty much just custom software. The rule used to be that it had to be prepackaged for a repeated sale license without modification. It had to be a tear open, non-negotiable shrink wrap license, and it had to be delivered in a tangible format. So you had to meet all three of these prongs previously, and that's a very high burden to hit because of that last bit, delivered on tangible medium, which meant the most software in Colorado was exempt, but they repealed the first and the second. So now moving forward, software is going to be taxable in Colorado as well. Utah did something very novel. Utah, basically, they created two different rules. Now, the rules were meant to, it's a very complicated rule. It's a very convoluted rule, but their basic goal was to target companies like Meta, companies that make a majority of their revenue from selling advertising services. And their goal was to create a excise tax and an advertising tax. And the point was to do one, to tax these larger businesses and to put age restriction protocols into place for youth to access certain websites. Just anecdotally, when states do put in these types of protections in place, they have a significant impact on reducing the amount of kids that access this. We had a prospect that reached out to us probably 3 months ago. We didn't know who they were. They had a very generic sounding name. So we took the call, come to find out that it was and they said they were they're providing digital content, but it ended up being a pornography company. And what we didn't end up moving forward with them as a client, but what I found to be very shocking when I was discussing their revenue with them is they could show, they were showing their revenue from 2022 through the end of 2025. And you could see a clear decline of about 40% in their revenue, which I found very odd because their website required credit card processing. But the guy mentioned that, since the age restriction went through, their revenue dropped by about 40%. So just a quick side note, these things do work. The new excise tax of 2% on covered transaction, digital images, audiovisual works, audios, gaming services sold by a covered entity required to perform age verification in Utah under the 78B-3. And then the other one, the one that was targeted toward Meta and those companies, was a tax of 4.7% on the gross receipts from targeted advertising using individual data profile. This is very similar to the law that Maryland put into place that we're going to touch upon in a little bit. But that Maryland law was unfortunately, depending on what side you're looking at it from, was repealed very recently. So here's a state-by-state snapshot of the digital and software media rules that were put into place over the last few years. So we talked about the California one, we talked about the Colorado one, we talked about the Utah one. We're going to touch upon the Washington one a little bit later on because the Washington rules that were changed were changed as a part of a much bigger rule where the primary impact of that rule was more so on the services side. So we'll touch upon that one a little bit later, but this is a quick snapshot of the rules that were changed in these 4 states. Okay.
All right. Effective January 1st, 2027, California's SB 122 will tax pre-written software and SaaS regardless of delivery method. Which of the following remains exempt under SB 122? A is pre-written software delivered on tangible media. B is SaaS assessed on a timeshare basis. C is custom software and cloud infrastructure. D is pre-written software delivered by download. This is our second of 4 polling questions. And answers are starting to roll in, and the majority say C, custom software and cloud infrastructure.
Yep, that's the right answer. Custom software is exempt in most states, and cloud infrastructure is also going to be exempt. And the reason they exempt the cloud infrastructure is because in addition to software, the cloud infrastructure as well as platform as a service include a lot of other things, and that's why they tend to keep those as non-taxable. So the next thing we're going to touch upon is the taxation of services. Whenever I speak with clients that are in the services space or prospects and they're wondering, hey, I do this service, I don't know if it's subject to tax. The way I always start those conversations is, if we're in 2026, we have to have a conversation about it. If we were talking in 2016 and the client says, I work in services, no services were taxable back then. And what's happened over time is more and more services are more and more likely to become taxed. So the first state, as I mentioned, as we were finishing up the last part, is Washington State. This is Washington State. Got a lot of news last year when they implemented their billionaire tax, and it resulted in people looking at properties in Florida and Texas, other low-cost states. While the majority of the attention went there, what Washington State also did is they started taxing a significant amount of their services as of October 1st. Before we get into that, it's worth mentioning that Washington State does not have a state income tax, or until very recently didn't have a state income tax at any income level. And obviously they have budget needs. So the way they decided, rather than implementing an income tax on a majority of their population, they decided to start taxing additional services. So the services that they decided to make taxable as of 10/1 were advertising. So digital and non-digital, layout, placement, campaign monitoring. So this is going back to a lot of the digital content and a lot of services behind that. IT and web development, custom website development, IT services, security services. So this includes not just IT related services, but also if you have ADT in your house, or if you use an armored cart service to pick up cash from your home to another, and even investigation services. Your company's making a hire of 50 employees or 5 employees, and you're doing background checks. Those things are also taxable. All of those kind of make I understand the reason for those, because a lot of those are automated. The one that really surprised me is temporary staffing. Temporary staffing is taxable in a few states. Actually, it's taxable in Washington State. It's taxable in Pennsylvania. I believe Washington, D.C. And this is taxable when so the way it works is a company hires Robert Half. The employee is going to get paid $100,000. Robert Half gets 20% or 25%, or Robert Half is a staffing company in the Northeast, for those that aren't from this part of the country. And that $20,000, that $25,000 referral fee, now that's subject to tax. And it's what's also subject to tax is if you have an employee and you're hiring the employee through a headhunting company, and that employee, you're paying the headhunter $50 an hour, but that employee is making $35 an hour, that delta is also subject to tax. The next thing worth mentioning is Washington is one of the few states in the country that custom software is subject to tax. As I mentioned, in most states, it's not subject to tax. Washington is kind of an anomaly there where it is subject to tax. And then live presentations, again, going back to the fact that we're a digital economy. You can take gym, you can do online training classes at home. You can get all kinds of different things at home. So live lectures, workshops, and similar presentations are also subject to tax. There is an exemption, a carve out in there for telehealth and those kind of things, as it mentions at the bottom over there. But that was repealed because Governor Bob Ferguson was getting a lot of pushback from B2B businesses saying that this is tax pyramiding. Tax pyramiding is talking about if somebody provides a service, if you taxed all the goods that they used in providing that service, and now you're taxing the providing of that service, you're taxing, in theory, the thing twice. That's why there's manufacturing exemptions and things like that. So there is relief, but the relief doesn't kick in until January 1st, 2029. And for whatever reason, I assume that, for reasons I'm not really aware, what is going to get repealed, we went through these 6 services back here. Of those 6 services, 5 of them are going to be repealed. It's the software, customizing, custom software, consulting, data processing, security services, and temporary staffing. Advertising services, the same services that Utah and Maryland, tried to target. Those types of those types of services or businesses in those spaces, they are still going to be responsible for the tax. And it's worth mentioning that the relief that gets triggered in 2029 is only going to get put into place if all the lawsuits behind pulling back the new income tax survives their court challenges. So if the state loses on the court challenges related to the state income tax, then the relief is never going to get put into place because they need to get the revenue one way or the other. That's basically the point of that. Okay. So Washington's marquee 2025 example of services tax expansion drew formal veto request from the council and the cost. That's kind of the lobbying organization for the state tax overtakes tax permitting. I kind of walked through that. And then the Maryland one, the Washington one, what that resulted in is that temporary relief one. The Maryland one, the 3% tax on data and IT services and software publication, that one was, there were 4 rulings that came out, the Supreme Court came out with, the Supreme Court of Maryland came out with on August 14th, so about 12 days ago. And the big issue there is that not only did Maryland lose, is that they lost all 4 of those cases for a variety of different reasons, which means that it's extremely unlikely that that tax is ever going to get put into place. It's going to have to be significantly reworked. It was effective starting July 1st, 2025. It was it was repealed as of August. So I don't know what's going to happen with that 13 months. I don't know if a lot of businesses were being compliant or if they were just kind of waiting to see and how the state's going to handle the fact that this law is going to be pulled back. Okay. Kentucky and Louisiana, this is going back a little bit further, but they also made significant changes to how they were going to their definitions of what was subject to tax. Kentucky made the changes on SaaS at the same time that they made their decisions on other types of services. So they just said software as a service, they're going to count it as taxable, as well as parking services, security services, cleaning services, all kinds of different services. And then Louisiana through, it says 2025, but I believe that was effective 2023, actually. They did the same thing. So they started taxing a lot of different services. The 2 or 3 that were probably the biggest difference for Louisiana was the taxation of information services. That's doing background checks, any kind of thing, can kind of running ratings, quotes, or any of those things, buying data for business use. All of those things were subject to tax. And also they started taxing repair and maintenance services, which they didn't previously used to tax. So 2 smaller states that also had changes in the same space in the last few years. Okay, this is just talking about the 3 that were enacted. As I mentioned, they were not. The Maryland one was pulled back. The other 2 kind of went through. And you're going to see this kind of wave significantly increase moving forward. It's worth mentioning that if you look at these services, they were meant to kind of be put in chronological order of most likely to least likely to get taxed. So digital and IT related services, software as a services, you're going to see that being taxed everywhere. I mentioned earlier, I think there's only 1 or 2 states, major states that don't tax it anymore. Probably 10 to 15 states in total that don't tax it anymore, and that's only going to increase. Digital advertising and data services, those are the next kind of most likely services to get taxed, all the way up through the ones that are probably going to have the biggest political pushback from ever getting taxed are the professional services, legal services, accounting services, brokerage services, medical services provided by a doctor, blood drawing, those kind of services. Maybe those will end up getting taxed, but in general, professional services are the least likely ones to get taxed. and digital services are the most likely. And that kind of shows you where I think the ranking is between the different categories in between. Okay, what are the practical compliance applications? The practical compliance applications is, how is your client marketing your services, right? Clients will love to say that, hey, my product is X, Y, and Z when they're doing their marketing, and they want their product to almost be commoditized or be technology based, because if they're thinking about a liquidity event or selling, that gets them the higher EBITDA. But understanding that, hey, by saying that your product is, everybody wants to be involved in the AI space somehow. Saying your product is very much leaning on AI or heavy on SaaS, that might work great for marketing, but now you're going through an audit, or an auditor is looking at your website before they're going to target you for an audit, and they're thinking that your service is likely to be taxable because it's an IT service or it's some kind of data processing. But then when you're going through the audit, you're saying, no, I'm actually this professional service in the insurance space or the health space or the design space, and that kind of creates an issue. Sourcing rules for services remained unsettled. What Wayfair did is said the benefit is derived where the services are received. But what's complicating that is the work from home. If you're a company that's located in New York, but your employees in Pennsylvania, and they're delivering the service to some customers, some design services to some company in Florida, states are trying to argue, well, why can't I say that the benefit was derived in New Jersey? Because that's where the income for that person is being received. And the only way the states can get around that is by drawing very nuanced and detailed publications to go through that. And that's leaving a lot of ambiguity up in the air. Previously exempt providers are facing new registrations. If you were a staffing company, and if all you did was staffing, now you have to be worried about your services being taxable in a handful of states. I have clients that have 2 or 3 offices, New York, Pennsylvania, and London. Pennsylvania taxes staffing services. So now they're having to tax and learn about sales tax, even though that's about a quarter of their business is from that one office. And this is something they never had to consider before. And now they have to factor that into their pricing, because as I mentioned before, in Pennsylvania, if you're billing out your employee at $75 or $50 an hour and you're paying him $30 an hour, now you create an issue, because either you're going to eat some of the tax, or you're going to let your clients know that your profit margin, for lack of a better term, or your spread is $20 an hour. And that creates issues because they don't know how to handle something like that. Exemption certificate management, professional services or service-based businesses never had to worry about that. And then the tax pyramid is something I mentioned a few times. Last thing to mention here is that random point about the multiple points of use exemption. Multiple points of use is talking about the fact that if software is taxable everywhere, the different states want to get their piece on it. So if you're getting, if your client is located in a state like New York, Pennsylvania, Washington, Utah, all of these states have the multiple points of use, where it basically says, if only a third of your employees are located here, you only have to pay a third of your tax here, and then pay the other tax in the other jurisdictions. And that creates an issue about clients, because when they get audited by that other state might ask them like, hey, you're paying the New York tax, but half of your employees are located in California. Why isn't California getting any of the tax? So these are all considerations that companies are having to put into place. Third question.
All right. Washington's ESSB 5814, which was effective October 1st of 2025, newly taxed several service categories. Which service did ESSB 5814 leave taxable even after Washington's own 2026 partial repeal, or SB 6346? A is customs software and IT consulting. B is temporary staffing services. C is advertising services, and D, security services. And again, this is 3 of 4 polling questions. Also, if you have any questions for Kamal, please use the Q&A feature in the upper right corner, and we'll get to them after we finish the presentation. So it looks like it's fairly evenly divided with C, advertising sales. number one answer, followed by A, custom software and IT consulting, and then B, temporary staffing services.
Yeah, the answer there is C. So what it likely threw people off with the custom software, because I've mentioned that custom software is the most likely type of software to be tax exempt, and it is, except for Washington. Washington taxes even custom software. So that's the first part. And the temporary staffing, that's again taxable in a few states. They are willing to repeal that if the other things with the property tax, not property tax, the state income tax. So the answer there was C. If the other case related to the state income tax appeal fails, they will keep it in place. But otherwise, temporary staffing will also be exempt starting 2029. Okay. Taxation of data centers. I'm sure we've all seen in the news all the different stories about data centers. Even within the data center ecosphere, there's all kinds of data centers. There's the data center that individual companies are building out, and then there's the data centers that don't get as much news, but you have small businesses that are renting data center space. So you have companies that are just building out data centers and subleasing the space. Then you also have businesses, Fortune 500 companies, clients we have in the Northeast that are building out their own data centers because they want to kind of control and manage all the data themselves. So we have had a few clients that have asked for our guidance on making sure that whatever data center investment they're making, they're being efficient and not overpaying taxes. So 38 states now offer dedicated sales and dedicated tax incentives. That's a little bit dated. There's been a few more after Kansas. Every state with a dedicated incentive also has this includes state sales and use tax exemption underneath it. So they'll provide sales and use tax for sure. And then on top of that, they might provide a property tax incentive and or some other incentives. What's typically exempt? It's pretty broad in the sense that some states are throwing in a very targeted exemption. So, maybe just putting it around the build out of the actual place and the servers and the equipment, but not including software and some of the other things. Other states are including everything. So the heating, the plumbing, the cooling, the electricity that goes into that data center, the construction and the site prep. We had a client that had a fairly good handle on it, and they knew that everything was exempt except for the soft costs. So some of the design services, New York State taxes design services. So they knew everything was exempt under the data center exemption. They didn't pay it on the software, the hardware, the cooling, the heating, but they didn't know that the soft costs were excluded. So that, and then the other thing that's surprising is the ongoing maintenance. That when there's an exemption, companies are targeted to bring in that big infrastructure exemption. That big infrastructure spend into the state, and then the states don't give them an ongoing exemption, thinking that, well, if the company spent $100 million, they'll continue to spend the $2, $3 million, $5 million, whatever it is to maintain the property. So we don't really need to provide an incentive. But now, because they're competing with other states, they're also including things that they wouldn't previously include in other exemptions. The states are coming out with very detailed memos and tax bulletins to detail what is and what is not included as the rules are going into play. Most of the states are requiring job creation. And so it says, 23 states require job creation. And it's pretty small. It's 5, 10, 15, 20 states. And only of those 23 states that have job creations, I'm not saying it's the same 23 states, but there's also 23 states that have a clawback mechanism. So you'll see in another slide where we talk about how many jobs it's creating. I think 22 of the 27 jobs, one study showed, created the bare minimum number of jobs. And that was like 20 jobs at a very low salary amount. The U.S. Chamber of Commerce has done a study and has shown that major operators, the largest facilities, are only creating 157 jobs. There is a lot of spend initially, right? When the 1,688 construction phase jobs, when the capital is being brought in and when it's kind of being affixed to the real property. These data centers have high cooling needs that buildings can get retrofitted for. So there's a lot of construction on the front end, but from an ongoing basis, that doesn't create the kind of growth that in many cases justifies the incentives that these companies are being given. These are examples of some of the credits or the investments that companies have to do in order to get the benefits. In Georgia is an interesting one. It has 25 million, 75 million, and 250 million. What that's saying is that in Georgia, there's a lot of rural space. So they want you to invest in smaller towns. So the way the law is written is that they don't specify towns, but they'll do it by population. So they'll say, if you invest X number of dollars in a town or county that has 5 to 20,000 people, this is the benefit you'll get. And what they're trying to get at is they don't care about companies investing in Atlanta, right? People want to be in Atlanta bad enough, so there's no reason to give them the exemption or any kind of benefit to invest in Atlanta. But here are the kind of investments that they're requiring. Kentucky, 450 million, owner tenant, 150 million organizer. That's the companies that are subleasing the space there. How many years the compliance window, that's how many years they have to kind of spend the money, or how many years they have to get the number of jobs that they need in place. So they'll get the benefit up front, and then they get a few years, 3, 5, 7 years to get the employment numbers and the infrastructure spend that they've kind of agreed to do. I know I think we have about 7-8 minutes. I'm not going to go through all of these slides, but this is just referencing the changes that some of the laws that were put into place in 2024, 2025. I think there's another slide, where we're talking about the different exemptions that the facilities put into place. But I want to jump ahead to talk about, that it's not only the states that are doing this, it's also on the county level and on the city level, because even within states, different jurisdictions are fighting for revenue. So New York, for example, New York operates 2 parallel tracks. There's a state sales tax exemption for internet data centers, and then there's local incentives that are negotiated on a project-by-project basis with the county, the industrial development agency within that county. The way New York did it, which is a little bit different, is in New York, the IDA takes title to the real property using a sale leaseback structure. The property is exempted from sales, mortgage recording, and all the other fees. So I mentioned before that sales tax is always a component, but New York, because they're competing with Texas and some of the jurisdictions down south that's cheaper for other reasons, they're also exempting any kind of mortgage recording fees, real property taxes. And then in lieu of all this, it's called PILOT. It stands for payment in lieu of taxes. They basically make a payment to the county, to the jurisdiction on some of the purchases at reduced rates. And that's kind of what negotiates that agreement. Because some of these counties, in addition to competing with the jurisdictions down south, they're trying to give and say, hey, New York, normally we charge this company 8.625, 4.5 is yours and the other is ours. We'll take less than that just to keep this business, or to keep this business investing within our jurisdiction. So that's why they'll do the payment in lieu of taxes. But now, like with the software stuff and like with the services stuff, we're seeing a pullback. Governor Pritzker in Illinois noted that 22 of the 27 projects that they facilitated in Illinois only created 20 minimum jobs. That was the minimum. They were hoping they were going to do more than that, but it didn't happen. So they're putting in a 2-year pause. New York, same thing. New York, Responsible for Data Center Development Act, but that also put a 1-year moratorium on larger facilities. Rather than sign a veto, Governor Hochul imposed a narrow 50 administrative moratorium pending an environmental study. So in one way or the other, they're putting moratoriums, they're putting executive orders, they're stopping this because they're seeing what's happening at the town hall meetings and all of these other things, where they're getting a lot of public pushback from these data centers, getting the amount of resources that they're consuming, that's creating cost of living issues. And then on top of that, to see the kinds of benefits that they're being given out, they're getting a lot of pushback. So some of the larger states are already kind of ebbing the benefits that they were giving, and I expect that to increase. Okay. all three areas that we've talked about today share a common thread. States are actively redefining what belongs in the taxable base. Sometimes it's broadening it, like with software services and streaming. Sometimes it's narrowing it to strategically compete for investment before reconsidering the narrowing under fiscal and political pressure. So, they're doing what they can. I expect there to be a lot of movement in this space over the next 2 to 5 years before the laws settle down. That brings us to, I believe, our last question.
All right. In New York's County Industrial Development Agency, or the IDA model, what mechanism allows the IDA to exempt a data center project's property from sales, mortgage recording, and real property tax? A, the IDA issues a direct sales tax refund to the operator after purchase. B, the IDA takes title to the project's real and personal property or uses a lease back paired with a pilot agreement. C, the state legislature grants blanket exemption with no local involvement. And D, the operator self-certifies exemption eligibility with no IDA review. And this is the fourth of four. If you have any questions for Kamal, please use the Q&A feature. We do have about 4 minutes remaining in this presentation in order to meet NASPA regulations. And it looks like the majority say B, the IDA takes title to the project's real and personal property, but that's, and then C, the state legislature grants blanket exemption with no local involvement.
The answer there is B, the IDA takes title of the project, real and personal property. That's just a way for them to get around the way the rules are structured. So that way they can get around the state rules of having to record a bunch of taxes and fees to, again, lower the cost that the client has at the end. The last thing I want to mention before, I think that's, yeah, I know I'm going to give a couple minutes for questions, but the last thing I want to mention is last night, when I was looking into the presentation, I looked into the Maryland one. And as I mentioned, that one got repealed on August 14th. And so it's very unlikely that it's going to get into place. All the other ones have been gone through the appeals process, and most of them are going to stay in place. So because of that reason, I expect more and more rules to come about and more businesses to have to kind of worry about this. So if you have any clients, that have any issues that you don't feel comfortable asking, I think my contact information is here. Please feel free to shoot me an email or give me a call and we can talk about it. Let me see if there's any. Do you see any questions?
There is a question, yes. Do you see it, or would you like me to read it?
Yeah, I gotta fix the screen. If you can just read it to me, I can.
Okay, it's from Joseph. He says, sourcing services. Recent California case did not source services received in California because the provider was not unitary. Generally, are all services received in a state sourced to that state, irrespective of the legal structure of the provider?
Yeah, I can see the question. Thanks, Ann.
Okay.
Yeah, Joe. So usually the way the law in the state is written is they refer to a term called benefit derived. So where was the benefit derived of that good or service being purchased? So it's easy when it's a good, it's wherever you take the possession. When it's a service, it's also where the service is delivered. So if it's an HVAC service, where was the building located? If it's a digital good, they're going to base it on where the invoice of the customer says the customer is located. So if the invoice only specifies one address, the state's going to assume that that's the address. If there's multiple addresses, they're going to look at where was that information or that service received. It's irrespective of the legal structure of the provider. It's where was the customer located. That's what drives it.
Okay, we have just about 50 seconds to make our minimum. Is there anything else compelling that you are seeing in the future or the near future?
Yeah, I think what's worth mentioning is going back to the slide where I was showing kind of the range of the services. What they're trying to target is services that can either be digitized or leverage very heavily on AI or other tools. So it's not really a human doing them, or services that can be offshored and then just the benefit is derived here, right? So those are the kind of services that companies are, not companies, that states are targeting, because the thinking is that those are services that are easier to tax, because this is an overseas population that's providing the services, and it's not really a U.S. based population. So politically, it's easier. And then the other thing is with digital goods, it's easier because, again, it's not a human providing them. So that's why they tend to focus on those types of services.
Great. That brings us to 50 minutes, and we've asked 4 polling questions. Again, if you've responded to 3 or 4 and attended for 50 minutes, you should receive your CPE certificate within the next 3 business days. And I think that there are no more questions. So thank you so much, Kamal.
No problem. Thanks, everyone. Take care.
Bye.